Hey, so today I will be briefly explaining the accounting conceptual framework. To better understand what that is, let's first discuss a normal conceptual framework. A conceptual framework is a set of guiding principles, that is, a series of ideas or concepts that can influence decisions being made in a particular area. An accounting conceptual framework is described as a coherent set of concepts that are the basis for the accounting standards used for financial reporting. The principles in the conceptual framework are much broader general concepts which are used to provide guidance and be applied to a much wider range of decisions relating to the preparation of financial reports. On the other hand, the accounting standards provide specific requirements for a particular area of financial reporting. The conceptual framework moves in a series of levels. It begins with the much broader questions and principles and gradually narrows down to more specific issues. The levels are all linked, and the questions posed in further levels relate to the answers from the previous level. The first level discusses the objective of financial reporting. The second level talks about the characteristics and elements of financial reporting. And the third level discusses the how, or the implementation of the financial statements. The first level of the framework is the basic objective and the reporting focus. The framework is concerned with general purpose financial reporting, which are financial reports intended to meet the information needs of users. These would be lenders, investors, and creditors. These users need this information so they can make decisions about whether they want to provide resources to the entity. The second level discusses the fundamental concepts. Companies must decide what type of information they want to disclose and how to disclose it. Their choices are determined by which method of reporting best provides the most useful information for their users. The qualitative characteristics of accounting information distinguishes between better and more useful information from the inferior and less useful information. There are also the fundamental qualities which extend how the information should be reported. These are relevance and faithful representation. There are also enhancing qualities which complement the fundamental qualities. These are comparability, verifiability, timeliness, and understandability. Also, in the second level is the basic elements of the financial statements. These are assets, liabilities, equity, income, and expenses. The third level has quite a lot of information to dissect. It explains how companies should identify, measure, and report financial elements. There are several basic assumptions to be made. The measurement principle is how an entity should measure the elements of the financial statements. There are two categories of measurement bases, both of which can provide useful information, so it is important to consider the nature of the information that the measurement basis will produce, as it needs to faithfully represent the measured transaction. The two measurement bases are historical cost and current value. There are also important recognition principles which change the way things are reported. So while measurement means how and in what amounts to recognize, recognition discusses when or whether to recognize. More specifically, whether an element is included into the financial statements. Derecognition is the opposite. It is the removal of all or part of recognized assets or liabilities from the financial statement. The framework goes into much more depth about criteria for recognition and derecognition. The final part of the conceptual framework talks about constraints, the most notable one being the cost constraint. This relates to the idea that benefits derived from providing accounting information must exceed the cost of providing that information. The main takeaway is that the accounting conceptual framework is the broad guidelines upon which the accounting standards are made. It is concerned with providing information in the best way to users of financial reports so they are able to make informed decisions.